Are you ready to dive deep into the financial metrics that will help you maximize your profits and achieve sustainable growth? Buckle up, because we're about to embark on a comprehensive journey through the essential financial concepts that will transform your business. This is one ride you don't want to miss. Let's start with the foundation of any thriving business: cash flow. Picture it like an iconic scene from The Wolf of Wall Street, where Leonardo DiCaprio's character is swimming in a sea of cash. That's the kind of positive cash flow you want in your business. It's the inflow and the outflow of money that keeps your operations running smoothly. When you have more money coming in than going out, you can invest in growth, upgrade your equipment, and take on new opportunities. However, be aware of dangers of negative cash flow, which can be treacherous. It's a situation where your outflows exceed your inflows, and it can quickly capsize your business if not addressed promptly. To steer clear of a cash flow crunch, you need to refine your invoicing processes and maintain a 13-week cash flow report. By staying on top of your invoicing and monitoring your cash flow regularly, you can anticipate any changes in the financial tide and make informed decisions to keep your business afloat. So you may be asking yourself, what is a 13-week cash flow report? A 13-week cash flow report monitors the inflows and the outflows of your cash flow to help you determine how much cash you'll have each week. And as you stretch out over the 13 weeks, it shows you whether you're going to have cash flow crunches or whether you're going to have excess cash flow. So I wanted to just do a very simple 13-week cash forecast, just to how to build one out. And what you would start with is your beginning cash on hand. Okay. Let's say you start $40,000. Okay. Now what you need to do is, what are your cash inflows for the week? And inflows are monies you're going to receive. And let's say your inflows are going to be $10,000. And what are some other things? Maybe bank loans, if you got credit line advances, investments that you converted into cash. These would all be various types of inflows. Then from there, we have to account for our outflows, and those are bills we're going to pay. So this would be week 1 of our 13-week forecast, okay? And then we do our outflows, and our outflows are going to be payroll. So if this week is a payroll week, we're going to pull that out. It's going to be, our fixed cost, if we're going to pay rent, utilities, software, all those, maybe credit card payments, things like that. So let's say, our outflows, we have payroll is $15,000. I'm going to put it into brackets to indicate it's a negative. And let's say just our general vendor payments, we're going to be cutting our accounts payable payments. We're going to be cutting $5,000. We're going to be paying $5,000. When you take these numbers, basically, if you take this as 40 plus 10 is 50, and then you add these two, it's 20K. So you're going to minus it from the 50, and then you'll get 30K. So we're going to end our projected ending cash for week 1, ending cash is 30K. And then we would kind of build this out for each week until we're 13 weeks out. As you do this, you get more precise with it, but it'd give you a great idea of where you stand on a cash flow basis. And this is especially crucial when you're in a cash crunch situation. Depending on your business size, I wouldn't normally recommend a business owner spending time doing this. Usually you're going to have some type of financial expert helping you do this, so you're not wasting your time preparing this. But if you have a very simple business, maybe you're very early on in your business and you don't have a lot of transactions, then I would recommend you initially doing this and just learning the ins and outs of your business. Next up, let's talk about profitability ratios. These are like the friends of the financial world. They'll always be there for you, providing you valuable insights into your financial performance. First, we have the gross profit margin. We're going to call the gross profit margin ROS, the reliable one. It gauges your service efficiency. It measures how much profit you make after accounting for the cost of goods sold. A high gross profit margin indicates that you're managing your costs effectively and pricing your services optimally. You can have your sales, okay? We're going to just do this for the month, and we'll do June. We're just going to pick on June. So the month of June, your sales are, let's say, $110,000, okay? That's your total sales. Now, you have direct costs related to getting those sales. The most common term is called cost of goods sold. Now, sometimes you'll hear COS, cost of sales. Sometimes you'll hear COS, cost of services. they all mean the same thing. And what these costs are is they're the direct costs against sales. So what are direct costs against sales? So labor is a common one. So technicians would be an obvious one, where when you pay your technicians to go out on a job site and complete a job, that's a direct cost of the job. So we had $40,000 of direct labor, okay? So this isn't just all your labor. This is just your direct labor for technicians and people that are directly responsible for creating that revenue. They're going out on the job sites. The next common one is supplies or materials that are required to do that job. So if you're in the gutter business and you're going out and buying gutters as part of a job, that would be materials and supplies related to the job. So we would put materials here, and let's say materials are $10,000 for the month, okay? And the payroll taxes related to labor, I'm gonna just say are included in this. These two total $50K. So then what we would do is we would say our gross profit, and we would calculate this. So 110 minus 50 is $60,000. To take it one step further, we would then take the $60,000 and we would divide 60 by the 110, $60,000 by the 110, and that would be 54.54%. And that would mean that we have a 54% gross profit margin, GPM. Oftentimes, if you do have a crazy high gross profit margin, it usually means we're leaving out cost of goods sold items, is what I often find. So this is just a really simplistic way for you to help you to understand gross profit margin. This is a critical number. I want you guys to know this inside and out, because what this allows you to do, once you get a real tight gross profit margin, so let's say we had 54, we would be like, man, that sounds really good, but it sounds almost too high. And sure enough, we found out maybe we're missing a couple items that we need to put in here. And then once we revise it, let's say it drops down to, 40.12%. Now we're like, wow, how can we move this lever here to get this up? We really want to get our GP, our gross profit, up to 45%. What can we do? Is it in managing labor more efficiently, getting our team to be more efficient? Is it maybe our materials costs, talking with our suppliers and getting better pricing? These are the things that we need to think about when we've got some type of stake in the ground to manage, and that's that gross profit margin. That's that percentage that we're trying to manage. The more that we can get this number up, the more profit margin that we have to pay our overhead and to also leave profit for us as the owners of the business. Net profit margin is more like Rachel of Friends. It takes into account all the factors to give you a comprehensive view of your bottom line health. It's a more holistic measure of profitability, considering all fixed and variable costs before arriving at your actual earning. To calculate your net profit margin, divide your net profit by your total revenue and multiply by 100. This percentage reveals how much each sale price is retained as your profit after all expenses have been accounted for. By focusing on improving your net profit margin, you can ensure that your business model is sustainable and positioned for long-term success. Okay, guys, so this next one, we're going to talk about net profit margin. So what is net profit margin? So net profit margin is the final number in your financial statements. So let's just kind of go through this exercise somewhat quickly. We're going to have sales here, okay? Then we have cost of goods sold, and we're going to take sales minus cost of goods sold, and that's going to be our gross profit, okay? Then we're going to have our operating expenses. Now, depending on how granular you are, we could have sales and marketing expenses in its own category. We could have G&A in its own category. So we could definitely build this out more, but I'm going to keep this simple to just operating expenses. So this is essentially our overhead. And then down here is our net income. And our net income is also known as our net profit margin. Net profit margin. So let's fill this out with some numbers. Our sales are 100K, okay? So we're going to plug that in here. Our cost of goods sold are 60K, okay? So we're going to subtract from our cost of goods sold 60K from the 100K of our sales. That's going to give us 40K of gross profit or gross profit margin, okay? And that's little commas here. And so that would be a 40% gross profit margin. You with me? So 40 divided by 100 is how we get 40%. That's an okay gross profit margin. It's not bad. We're definitely going to make money. I'm always trying to push that number up because then we have more money to cover our operating and then more money to pay the owners. So that's what we're thinking about. So now our operating, let's say, is $30K, okay? So operating expenses are going to be our insurance expenses, our overhead, utilities, software applications, all these SaaS applications that now require monthly fees. That's all included. So now we've got, if we take the 40 minus the 30, that gives us 10K, okay? So 10K divided by 100K is 10%. So that's our net profit margin, 10%. Now, Tyler, is that a good net profit margin? So generally, as a rule of thumb, and it's going to depend on the industry, but most of the clients that I work with, I want to be at minimum 10%, but I really like to see them in the 20% or higher on the 20%. Now, once again, it really depends on the industry. You know, a software company, once they have a fully developed product, is going to have crazy high net profit margins, or they should. Whereas maybe a very low-end construction trade, sometimes you can see 3 or 4%. But most businesses are going to fall in this 10, 20%. And I want to really push. I want to work together, and I want to get this number up to 20%. Because once again, we get this number up for 20%, this 10K becomes 20K. Now, you as the owner can pay yourself. You're covering your operating easily. You have more cash flow. You can invest in the business, grow it, scale it. Just so many things you can do. So many times operating becomes bloated, and we want to get that operating down. Now let's dive into the world of labor costs. Managing these expenses is like playing a game of Jenga. One wrong move and everything comes tumbling down. Labor costs encompass hourly wages, payroll taxes, salaries, and employee benefits, and they can quickly eat into your profit margin if not managed effectively. It's crucial to find the right balance between fair compensation and financial sustainability. One innovative strategy to optimize labor costs is to implement performance-based pay. By combining a lower base pay with the potential to earn more based on performance, you can motivate your employees to be more productive and contribute to your company's success. It's like having your own Gandalf guiding you through the mines of Moria, helping you navigate the complexities of labor cost management. Additionally, keeping track of real-time labor costs and enforcing time clock compliance can help you avoid unnecessary financial outlays. Utilizing tools like expense management software that integrates with platforms such as NetSuite, QuickBooks, and Xero can streamline the process and provide valuable insights into your labor expenses. Speaking of employees, let's not forget about revenue per employee. This powerful ratio measures how well your employees are performing and how efficiently your business is generating revenue. To calculate it, you simply divide your total revenue by the number of employees. A high revenue per employee indicates that your team is performing as a well-oiled machine, leveraging their skills to generate more revenue with fewer resources. However, it's essential to measure this metric against industry standards to ensure your company is performing at its best. Customer acquisition cost, or CAC for short, is another crucial metric that you don't want to overlook. Think of it like the mission impossible of marketing. Your goal is to efficiently allocate your budget to attract valuable customers without breaking the bank. CAC measures the cost of acquiring a new customer, including all the marketing and sales expenses. By understanding your CAC, you can evaluate the effectiveness of your marketing efforts and make data-driven decisions to optimize your strategies. But CAC alone doesn't tell the whole story. To truly gauge the value of your customers, you need to compare it to their customer lifetime value. This is where the relationship between CAC and CLV becomes crucial. Ideally, you want your CAC to be less than 1/3 of your CLV. It's like having your own Ethan Hunt, ensuring that your customer retention efforts are paying off. A CAC over LTV ratio below 1 confirms that the revenue you generate from a customer exceeds the cost of acquiring them, ensuring the sustainability of your business. Now let's shine a spot on client retention rates, the hidden gem of increased profitability. They're like the Breaking Bad of financial metrics, often overlooked, but incredibly valuable. A high client retention rate indicates that you're delivering exceptional services and fostering long-term relationships with your customers. It's more effective to retain existing clients than to constantly acquire new ones, as satisfied customers are likely to become brand advocates and drive referral business. Moreover, long-term customer relationships contribute to a continuous improvement in your service offerings. By actively seeking feedback from your loyal clients, you can identify areas for innovation and operational enhancements. This valuable input can help you refine your services, increasing revenue and decrease operational costs associated with client turnover. It's like having your own Walter White cooking up a recipe for success. But instead of meth, you're focused on delivering top-notch services that keep your customers coming back for more. As your business grows, it's crucial to keep your eye on the break-even point, BEP for short. This is the inception of financial analysis. Your BEP is the point at which your total revenue equals your total cost. It's a critical benchmark for understanding when your business starts generating profit. Conducting a break-even analysis is like navigating through different layers of a dream. It helps you assess how changes in sales volume, pricing, and costs impact your profitability. To calculate your break-even point, divide your fixed costs by your contribution margin. This is your price per unit minus variable cost per unit. This will give you the number of units you need to sell to cover all your expenses. By understanding your BEP, you can make informed decisions on pricing strategies, cost management, and sales targets. It's like having your own Warren Buffett guiding you through the complex world of financial projections. Finally, let's talk about scaling your business. This is the stranger things of growth. Just like the young characters in the show, your business needs to be prepared for the challenges and opportunities that come with expansion. Before you embark on this exciting journey, ensure that your brand identity is as strong as Eleven's powers and that your business structure can handle the increased customer demand. To scale effectively, focus on providing a limited range of high-demand services exceptionally well. Implement technology that boosts output without requiring significant additional resources. This approach helps you avoid scope creep and ensures that your growth is sustainable. It's like having your own Hawkins team working together to tackle the challenges of the upside down while maintaining the quality and efficiency of your operation. As you navigate the financial landscape of your home service business, remember that success is not just about reaching your destination, but about enjoying the journey. By mastering these essential financial metrics, you'll be equipped with the knowledge and tools to make informed decisions, overcome obstacles, and seize opportunities for growth. Think of yourself as the captain of your own ship, steering your business through the ever-changing tides of the market. With cash flow as your compass, profitability ratios as your map, and customer retention as your anchor, you'll be well prepared to weather any storm and emerge victorious. So there you have it, the comprehensive guide to maximizing your profits and achieving sustainable growth in your home service business. Keep these financial metrics at the forefront of your mind, and you'll be well on your way to building thriving, successful enterprise. Now, one last thing I want to add. If your company doing over $1 million a year and your goal is to scale and grow your business, what happens a lot of times is getting to the next step oftentimes becomes a roadblock. And someone like a small business CFO can help you understand these critical metrics that we've just discussed and how to include them and strategize them to get to your next level. If this is something that you think can help you, click on the link below. Let's hop on a quick call and discuss how I can help your business get to the next level.